Good afternoon, and welcome to another edition of Sector Spotlight featuring the consumer staples sector. My name is Shane Laidlaw, an analyst on the team, and I'm joined in studio by our sector head, Howard Penney, to go over some of our top ideas and some overall macro themes that we're thinking about. With that, Howard, take it away.
Thanks, Shane, and good afternoon, everyone. Thank you for tuning in to the Sector Spotlight on consumer staples. As Shane said, I'm Howard Penney, and I also cover the restaurant industry here at Hedgeye. But today we're going to focus on the consumer staples. We're going to go over a few macro themes that we're seeing playing out in the space, touch on a few other ideas, some sentiment valuation work, look at some companies, and then we'll end with Shane talking about a few of our best ideas. So let's dig right into the first slide, which I believe is page 4, and that's the 3 key themes that we see playing out through the space today. One, M&A is a positive, and that is certainly something we've seen in the last couple of weeks here in the space. But the other piece of it is the M&A space. Has ZBB, zero-based budgeting, gone too far? And we're starting to see that maybe even in the king of ZBB, Kraft Heinz, with their European region, and then just recently as far as General Mills' most recent quarter, talking about maybe they've been cutting costs too far. So we're going to have to see how that plays out this year, but that's something that we've been concerned about over time, that the cut that a lot of these companies are making into their costs are cutting a little too far into the bone, into R&D, and some of the issues that drive long-term growth. The second key theme is the reflation trade has a long way to run. This is how we're playing the space today in terms of some of our best ideas. Costco, Whole Foods, U.S. Foods, and the grocers in general to a certain degree. We like the space, we like the names, and I'll go through some reasons here in a second why, and then we'll, as I said in a second, Hain. You know, one of my favorite shorts is Hain,
but you're like Shane. Better than you like Hain.
Yeah, exactly. I do. You do. But we'll go through that in a second. And then the implications of the Trump administration. This one's hard to really factor in and know what's going to happen because there are so many moving pieces to it between the border tax adjustments, tariffs. And even you can take it to the restaurant space and maybe a tax on avocados and how that might hurt Chipotle. I just had to throw that in. But moving on to the next slide, slide 5 is our idea list. As I said a second ago, the longs we have today are currently Whole Foods, Costco, U.S. Foods, and then General Mills and Pinnacle on the M&A side, as we'll touch on a slide in a second. And then my favorite short is Hain. We just recently did a note on Hain going through the recent press release that they put out, or not recent, but the press release they put out stating that everything was okay from an accounting standpoint. And we took apart the press release and actually had a U.S. Marshal take apart the press release, U.S. Marshal in charge of statement analysis, and looked at the verbiage and the wordage of the press release from Hain and came up with some interesting conclusions. Nu Skin and Kroger on the short bench, and then on our long bench, Pepsi, Conagra, Smucker's, Hostess, and the Performance Food Group. So turning to slide 6, you can see what the M&A landscape looks like. On the left-hand side, some of the recent deals, and then on the right-hand side, some potential acquirers and or targets. One thing to note is that we're coming up on 2 years since the Kraft Heinz deal, as you can see at the bottom on the left-hand side. So the question I think everybody is asking in this space is, what will 3G and Buffett buy, or can 3G and Buffett buy something, and or what will Kraft Heinz buy? And you can see we've got at least, you know, what a lot of people in the space would think is a done deal, and that's the Kraft Heinz Mondelez, but there's also General Mills potential, and then General Mills could buy Snyder-Lance or McCormick. Pepsi's out there, Conagra could buy Pinnacle could buy any one of these smaller brands down there. So as you can see, M&A plays a big key role in some of this space, and why you got to be very careful about being short in this space, and you got to follow really bad companies like Hain. Slide 7 is a look at performance over the last 6 months. As most of you probably know, the staple space has dramatically underperformed the S&P. And year to date, it's also underperformed, but just slightly. And clearly, part of the reason why that has happened is on slide 9. As you can see, the daily U.S. correlation to the S&P sector performance there. Consumer staples over the last 6 months has a negative correlation of 0.92. Slide 10 is a look at the XLP versus the market, the S&P 500 over a 1-year basis. And again, we just looked at some of the reasons why that is. But over 3 years, they've performed a little bit better. And again, the dollar's been a nice tailwind for them. But operationally, this is the hard part about being a fundamental analyst in the consumer staples space, is it's operationally, there's no top line growth, and margin improvement outside of cost cutting is hard to come by. So, and you've got excessive valuation. So it's really not it's really hard to find longs in the space, frankly. But we're doing our best to try to come up with some really good ideas. On slide 11 is kind of breaking down the space by subsector. On the left-hand side, in the top left, you can see the 6-month price change by subsector, with tobacco leading up nearly 6%, and then on down to the beverage and alcohol space, down 7.8%. On the right side of the top part of the chart there is the analyst rating. So that's on a rating scale of 1 to 3, 1 being buy, 3 being sell. The ag inputs are where the analysts favor all the names for the most part, and then household products and food distribution are lagging in terms of where analysts don't like it. Again, these are sell-side ratings. And I just would point out that 2 of the companies that we like, that we're long, or where people don't like, and that's in the food retail, food distribution. And the reasons why most people don't like it are fairly obvious, and that's deflation and the competitive issues that a lot of companies are facing. And we see some of that abating. And then, in the beverage and alcohol and branded packaged food, most of the companies there get good ratings or positive comments from analysts, just basically because of the M&A potential. But interestingly enough, again, looking at slide 11, on the lower part there, you can see, while analysts don't like the food distribution business per se from an analyst rating standpoint, they actually have the best 6 months revenue revision trend at 2.8%. And interestingly enough, on the right-hand side, the best 6-month NTM earnings revision trend. So the fundamentals of the food distribution business are the best in the space, yet the analysts don't like it. And then you'll see in a second, it's also the cheapest, or one of the cheapest space. Another way of looking at it on slide 12 is the sentiment and the trend in sentiment. Again, food retail, for the obvious reasons, are have the highest subsector median short interest, but coming down over time, and I think partially that's due to the bull market, but also I think the short interest in the branded packaged food has come down recently because of some of the M&A thing. And then really not too much to speak to in terms of the analyst ratings, kind of a flattish for the most part, with beverage and alcohol picking up a little steam here of late from an analyst rating standpoint. The fun part begins on slide 13. I love slides like this. So this is a look at short interest by name in the consumer staple space, with Budweiser and Diageo taking the gold and silver medal, CCE in third place in terms of where people don't believe that they are great shorts, and then Sanderson Farms and of course Herbalife take the gold medal and with the most short interest. I noticed also, interestingly, that Sam Adams is a name that people don't like. And then Dean Foods is one that's sort of sticking out for us, and it's hard to hit our radar screen, DF, in the fact that you'll see a second that the dairy complex is turning around. Stock's actually done a little bit better, so there's been some short covering there. But the other 2 names I wanted to point out here is Whole Foods, which is also, I think people are too bearish on that with a fairly high short interest. And then where they're not bearish enough is Hain, which we've highlighted in gold there as well, where we think that company has substantial downside. The next slide is slide 14, which is the analyst rating. Again, looking at where, so this is the first slide. The previous slide was sort of a view of where the buy side saw the best shorts and where not to be short, and now we're looking at kind of where the sell side is. The sell side, obviously, and as the buy side, doesn't like Sam and Campbell's. And again, the sell side doesn't like Whole Foods, don't like General Mills, don't like Schmuckers, we kind of like Schmuckers. So it's just interesting to see, and we like to play. I don't want to be controversial for the sake of being controversial. I want to be right, obviously, but we see some things playing out here in Whole Foods and U.S. foods, which Shane will get to in a second. But it's also good to understand where you stand relative to what other people are thinking. Slide 15 runs through, again, the trend in valuations with beverage and alcohol on the left, on an EV to NTM EBITDA being the most expensive. And again, one of the cheaper places to play is in the food retail and food distribution business, and same thing with not too much of a trend in the PEs, but you can see where it's the most expensive game in town is branded packaged food and the worst fundamentals. So I understand food retail and food distribution are low margin business, lower return businesses, but the branded packaged food players, there's just no growth there. At least there's growth in the food distribution business, and you're getting it at a fairly good value. Slide 16 just runs through again by company, where you can see the EV to NTM EBITDA is, so not too much. Farms pretty cheap, but always cheap, and then always expensive is Coca-Cola. On a PE basis, same idea here. Just a nice spread to see where where the companies stand. I would just note that one of the cheaper names in the space on slide 17 is Kroger, and we don't think it's cheap enough, frankly. And now it's getting into some of the themes. So I've talked here a little bit about why we like the food distribution and food retail space, and we're playing the reflation trade, if you will. And slide 18 is complementary of our macro team, and it's their proprietary indexes. They look at where CPI is going over the next couple months, and clearly CPI is headed higher. And they're playing the deflation or the reflation trade as well. So we think a great place to do that is in the food retail, food distribution business. Again, going back to those previous slides, the street doesn't like it, the analysts don't like it. It's got good earnings revision trends, and now you've got, you're moving from a deflationary period to an inflationary period, so it feels like it's a great place to be from a long side. Again, as I said previously, as you can see on slide 19, the dairy and related product CPI is clearly bottoming and starting to edge higher. This has implications, as I said, for Dean Foods, which has a high short interest and could see some better fundamentals, but also two names that not necessarily in the staple space, but names that we don't like on the short side, which are impacted by dairy, and that would be Starbucks and Cheesecake Factory, which would be hurt by higher dairy prices as well. Got to throw in a bid there for the restaurant business. CPI of meats, poultry, and fish on slide 20. Still pretty deflationary there, but again, we're starting to see a slight uptick. So the rate of change is moving towards from deflationary to reflationary, although it's not technically reflationary. And again, one of the big arguments, I guess, for some of the food retailers would be this differential between food at home versus food away from home, which again is starting to see a little bit of a correction coming back into a more normalized level. But this definitely benefits the food retailers and to a certain degree, food distributors as well. And then lastly, we got some bit of news on consumer confidence today. Consumer confidence is definitely improving, although it took a little bit of a downtick today from cycle highs, but nonetheless still very positive in terms of the consumer confidence indices. So a little bit of an overview of some of the macro themes, and I'm going to turn it over to Shane, and he's going to walk through two of our favorite ideas, and that is U.S. foods and Whole Foods.
Great. Yeah. Thank you very much, Howard. So for U.S. foods and Whole Foods, and then actually we'll have one slide on Costco at the end there as well. The overarching macro theme here is the reflation trade. So just keep on thinking about that as we go through these slides, and we'll take you through it here. So turning to slide 24, the key points for our U.S. foods are 1, margin expansion through multiple avenues, 2, growth with independence in the healthcare segment, which is key, And then 3, the debt burden improving, which is allowing for future M&A. So just diving quickly into the first point here. So the 2 key points of the margin expansion story is they're pruning low margin distribution agreements with chain businesses in favor of independent businesses. And then they're also growing their private label, which we'll have a slide on later with more detail. The growth with independents and the healthcare segment, as I previously just mentioned, is the biggest contributor to the improvement in their case growth. This is something that they've been focused on far better than other competitors in their space. Cisco does it, PFG does it, but US Foods has better capabilities to enable independents to grow their own business. So we think they have a differentiating factor there, which we'll touch on. And then the debt burden improving. They used all $1.1 billion of IPO proceeds to bring their debt. And as of the latest quarter, their net debt to adjusted EBITDA is at 3.8. So as they continue to work this down, a long-term thesis here is that they'll continue to do small M&A. They did 5 M&A deals in the last year with about a run rate of $500 million in sales. So as they continue to do those over time, you'll see a continued improvement in margins and sales for the business. Turning to slide 25. So I think part of the bull story here is that US Foods will be able to close their multiple difference with Cisco, but there are a few things that are in their way for them to doing that. They have a big margin differential right now due to the different business structures and how they're working on improving those. And then they also have they have a lower amount of private label brand usage than Cisco, so that is also affecting this multiple. But I think longer term, as they improve those things, this multiple will close over time. Turn to slide 26. So for the next 3 slides, we'll quickly just go over some of the top things in more detail on why they are a differentiated business model versus other distributors. So the first one is their growth that skews towards independent operators. I'll just read this one quote by our friends at Black Box Intelligence. There is more growth in the total restaurant sector than in the chain restaurant numbers tracked by Black Box Intelligence, suggesting other players such as independent operators and smaller regional chains may be growing faster and taking share away from chains. And we totally agree with this. I think you see in the bottom left here that chains are projected to grow at 1 to 2% real sales growth, while independents are growing at 2 to 3%. I think there's a lot of qualitative things that you can think about of why independents are doing better. The management teams are more invested in growing the business because it's their own capital in the business, and I think they take more passion in growing the business and providing a better environment for consumers to enjoy their meal. Turning to slide 27 is their e-commerce initiative. This could be their single best initiative to enable independent growth and the growth within each customer, expanding the share of the plate. So in 2015, they had $15 billion in net sales that were generated through e-commerce, representing 67% of total sales. This compares to just 8% of sales for Cisco, so a big gap there in their favor. And then just for independents more specifically, they've grown e-commerce penetration from 8% in 2011 to 51% in 2016. The e-commerce penetration goes a long way to increase stickiness of clients, because as clients are able to input their data and build their menus within US Foods' e-commerce platform, they become more attached to it, more dependent on it, and that creates stickiness over time, and that helps their attrition rates. Turning to slide 28, the private label advantage. This is one space where Cisco probably still has the advantage as of today. US Foods' private label represents 33% of sales, up from 30% in 2010, which is a big improvement, and they continue to work on it. I think the most important thing to know here is that the private label gross profit per case is 2x manufactured brands. So as they continue to grow this as a share of their revenue, their margins will continue to expand. Turning to the fragmented industry, this dovetails off our thoughts that M&A is imminent in the future, and management has alluded to this as well. As you see, these are just the top 10 players. After this, there are 15,000 local and regional players outside of this list here. So it provides a lot of opportunity for US Foods to acquire more companies as they go forward. They continue to be focused on businesses that are, as they are, focused on independent restaurants, which will continue to improve their margins over time. And again, to reiterate, close that gap with Cisco. And then just turning to slide 30, a quick look at the growth in adjusted EBITDA margin. This is all due to the previous things that we just spoke about. This will continue to go higher over time as they continue to implement the initiatives and grow their base with independents. Turning to slide 31, a quick note on Whole Foods. We presented this black book back in September of 2016. It's a longer-term trade based on reflation and the recovery of the business based on some internal initiatives that they are doing. So turning to key points on slide 32, the initiatives to offset the macro environment. So a lot of companies, or a lot of food retail companies, have been taking discounts during this deflationary time just because they have to stay competitive. But Whole Foods hasn't really been pressured to do this in the past. They've always been the sole natural and organic food retailer. But as natural and organic has become more mainstream, they were actually forced this time to really rethink their business and invest in price, among other things. So I think as we come out of this deflationary period, you're really going to be able to see those initiatives shine through as sales should recover. Turning to slide 33, sentiment is very negative on the name, as you see, and it gets increasingly negative. I think one thing to note is that short interest has come down a lot since the peak back in July of 2016, it's still high at above 9%. So I think going forward, there is still more room for it to come down, obviously, as people become more comfortable with the reflation trade and the fact that the internal initiatives and John Mackey as the sole CEO really have this company under control. Turning to slide 34, just a little bit more of the same. It's trading at well below one standard deviation of its 5-year EV to NTM EBITDA average. It seems to have found a strong base here, and I think it's trading at a level where it's trading really close to that level where it's either going to get taken out or it's just going to continue to tread at this level until people see that positive momentum in comps, which we think will come kind of midsummer to late summer, and then it should shoot up from here back to the average levels. Then turning to page 35 for the comps. So now 5 quarters into a period of negative comps for Whole Foods. I think people have kind of written off the recovery story to some extent. We have not. At this point, our theory, and our theory has been the same since we put our black book out, is that the people that Whole Foods are losing as customers right now are fringe or aspirational consumers, and their core consumers are still strong. They're still there, they're still coming to Whole Foods, they're still buying the same basket sizes that they used to be. So we're starting to get to that point that those fringe consumers are kind of gone, and we're looking at a new base of core consumers that are there. And I think now we're starting to see that, and we'll see a slow progression forward of increasing comps as that is realized, as that kind of shows through in the numbers here. Because I think at the end of the day, Whole Foods is a very different shopping experience than going to Kroger. I'm not saying Walmart's the same consumer, but shopping at Walmart or a Stop and Shop if you're from the Northeast. And people are willing to pay that extra money to have that shopping experience. And yes, you have e-commerce, and they're participating in that with other partners such as Instacart. But I think the Whole Foods shopping experience still holds that luster, and that will continue to shine through going forward. Turning to slide 36, gross margins are another big contention for investors in Whole Foods. It's kind of like, where are they going to land? How much do they have to invest in price in order to improve the comps? I think as we look at where consensus is, it may not be too far off, but that's a good thing. I think that the street has come to kind of have some comfort with where the current consensus numbers are. And I think going forward that they'll probably be proven to be pretty accurate, maybe a little too low, but I think that's a good thing for the stock in the near to medium term. And then turning to Costco, it's a best idea long. We're digging in deeper now. It's also in kind of in our whole reflation trade story. It has 50 to 60% of its business is in food and sundries. So they've been experiencing excessive deflation in that. They've had excessive deflation in televisions, just to name a few things. And as you see, the comps are kind of coming to that point where they're finding that flat ground on the 2-year basis. And I think going forward here, it's also going to participate heavily in the reflation trade. And it's obviously a great business, and we think it's we don't want to use the word Amazon proof, but it's definitely have the widest moat versus Amazon compared to other competitors, given the value proposition that they provide their consumers. And with that, I think, unless you have anything else, we'll go take some questions.
I think questions would be great.
Okay, cool.
I think I'm going to start one and put you on the spot.
What are we doing?
So, will Kraft Heinz and/or 3G buy something in 2017? And if so, who will they buy?
I'm going General Mills.
Oh, okay.
And I don't think it necessarily has to be Kraft Heinz. It could be 3G and Berkshire. Go private. I know it's not an out of consensus thought. I think the more consensus thought is Mondelez, and with General Mills as like a 2 or 3 spot, but I think General Mills is my pick. Actually, I know General Mills is my pick. I don't think. Okay, then to the questions. So how do you think about your Hain short when M&A is such a big factor in the space?
Yeah, that's the classic question with Hain, you know, and I've been battling this question for years, as we've been short for a while. But frankly, the brands at Hain aren't that great, first of all. Second of all, the company was built upon acquisition, so they have a bunch of small brands that don't have great penetration and aren't worth that much, frankly. You know, yes, it is a natural and organic, and now the company's financials, you know, they haven't put financials out in 9 months. And again, you know, we did this 2 years ago when we first did our short call on Hain. As I mentioned in the beginning, we did statement analysis of, you know, of one, the press release, but two, we did a look at earnings calls 2 or 3 years ago, and you know, when you have someone, a professional, look at the verbiage that they have, it's easy to point out where they're just not being truthful with the street about what's happening in terms of volume and growth. We were very clear about their organic growth and not being able to get at the numbers. So it just doesn't add up. And you know, frankly, I was speaking with an executive in the natural foods category over the weekend, and you know, she's a buyer, right? And I was telling her, I said, "What do you know about Hain?" And she goes, "House of Cards." And this is just a buyer in the space. So there isn't anybody within the natural and organic space that has you know, any admiration for this company. So I think it's a house of cards, frankly, and I think when they report earnings or when they finally get their financials out, the $2 estimate that's out there, or $2 something that's out there, is probably closer to $1.50, maybe even $1. But whoever, if I'm wrong and someone buys it, short whoever buys it. It's just because it's a creepy company, frankly. It's just a creepy company.
Yeah, it has a potential write-down in the future.
A huge
written all over it.
Absolutely.
So I know we haven't done too much work on this, but any thoughts on Mondelez?
So we haven't done too much thoughts on it, and frankly, I don't know where we would get paid to do thoughts on it, because, you know, I mean, Ackman just upped his stake in it. And, you know, it is a foregone conclusion, frankly, not, you know, withstanding your General Mills belief, but that, you know, Kraft Heinz is gonna buy them. So, you know, I mean, that no one's gonna short it for that, you know, because it's gonna get taken out. So, you know, you're owning it for the trade, and you're owning it, you know, one of our long theses for part of the space is, you know, the M&A trade. So, I mean, it's probably gone.
Yeah.
And certainly the shareholders want it to be bought, so.
It's not cheap either.
Yeah, well, that's part of the problem with the group, right?
Yeah, that one's well above.
Yeah, that's true.
Makes General Mills look like a steal. So what are your thoughts, if any, on the beer industry, ABI, Europeans, Japanese companies?
We haven't done any work on those names. So again, it's a small number of names. I did some work on Diageo a few years ago, and you know, it wasn't something that I ended up liking. So we just haven't done anything on it.
Yeah. So I get you like all the names above the line on the best ideas list, but if you had to pick a favorite from the bench, what would it be?
Ooh, a favorite from the bench. Let's see what's on the bench. I forget what's on the bench. Pepsi. I mean, that's
Pepsi's your favorite?
I'd have to say. I mean, that is just an incredibly well-run company. But if that's, you know, too big, right, and you want something smaller and sexier, we haven't officially done the deck, but it's coming, but Hostess Brands. I mean,
Yeah.
that is just a fascinating little company.
It is.
So.
That goes right into the next question,
Uh-oh.
actually, so I'm glad you said that. What is your quick and dirty on Hostess?
Well, so market share gains, right? They've got a floundering competitor in flowers, so, and the business model and the margins, the asset light model, if you will.
Yeah, not having the DSD network is huge.
It is just there is so many things to like about that little company. And then new products also, I think, they've got some pretty interesting new products coming down the pike.
All healthy stuff.
All healthy stuff.
Getting healthier.
Deep fried Twinkies. You gotta love it.
With whole wheat flour, hopefully. All right. Restaurants is inevitably leaking into the question queue here. Are you still short Dine equity?
Yes. Very worried about that company, frankly.
Yeah.
Everything that we did a big deck on Dine a couple weeks ago, or December, I think it was. And they've got some real problems. They've got off-balance sheet liabilities that people aren't factoring in. They've got declining comps, declining profitability, cash flow issues. It's everything that's wrong with a asset-light model is Dine equity.
All right, so what is your view on Trump's ability to shut down larger M&A deals that create synergies, i.e. job cuts?
Well, now that's a great question. It's hard to, so if you look at what he's spoken out against the AT&T merger, I don't think the Kraft Heinz Mondelez merger would be something he'd speak out against. I just don't, I don't believe that that's the case. And certainly the companies are well aware of, what they can do and can't say, or what they can say and can't say about job cuts, but they could also look at that internationally, right? So cutting things internationally. So there's a way that they could articulate a strategy that would fall in line with the political environment that we face today.
Yeah. And then I'll ask this question just because you used to cover tobacco. Any thoughts on Altria, Emma?
No. Tobacco's an incredible business paying incredible cash flows, but they look, it's hard to analyze those companies. But.
Maybe a question for me, but feel free to answer the next one. What are the challenges that USFD's business face going forward?
I'll let you answer that one.
Yeah, so I think it's twofold. Labor, so labor both on their front and with their customers. So they have some MPP issues. We don't see it as a big issue, although we've spoken out about it on Kroger having a big issue with MPPs. But I think they're also going to be faced with rising labor costs in certain regions, which could affect their margins, given a low margin business. And then I think that labor pressure also dovetails into their second risk, which is a continued slowdown in the restaurant industry with increased margin headwinds specifically. So some restaurants could be faced with, or will be faced with, margin pressure in the mid-single digit range based on labor inflation. So that's how that kind of can flow through both their P&L and their customers' P&L, which could inevitably affect them as well. And then thoughts on food inflation impact on restaurants?
So you have to understand each menu item, or each company and each brand and the menu items and how they're impacted. So, like we spoke to Cheesecake Factory as a potential short. It's loved by the street today, except for us. And dairy inflation is going to hurt them. A company like Chili's, which has a much broader menu, isn't really impacted by any one protein. Obviously, if steak goes back up, the steak chains will be hurt. So it's really kind of a case-by-case basis and understanding which protein's doing where or what commodity is doing. Inflating coffee is starting to go back up. It's going to have, at least not a financial impact on Starbucks, but people will begin to think that it might have a financial impact on Starbucks. So to a certain degree, it's an overall negative to some degree. Now, if you get, certainly we'll go back to the Cheesecake Factory. If there's, dairy inflation or labor inflation, it's a disaster. So if you use that as a microcosm for what potentially could happen to the industry, if we're going to see significant food inflation when we have labor inflation, you don't want to own these names.
Yeah.
Because they don't have pricing power to offset it.
No. And some have been pricing too much anyway.
And some have been pricing too much.
So thoughts on Red Robin?
Really? I love Red Robin.
Small company, but.
Yeah, no, it's a small company, but it's, I have my model, if you will, for restaurant investing is all about cash flows and, following the cash flows and how people invest the incremental capital that is thrown off by the restaurants. And the team that is now running Red Robin is probably one of the best in the industry, and they're doing what they should do with their capital, and they're cutting CapEx and cutting growth and cutting expenses. And sometime in the next couple of quarters, you're going to really see this flow through in the margin and the earnings of the company. So, it's hard to imagine a casual dining company that could go up 50% in this market, but it's probably one that could.
Yeah. All right. Well, we'll end with the end of the queue there. So thank you everyone for joining us this afternoon for this edition of Sector Spotlight. Please join us next week when healthcare will be sharing some of their top ideas in the space. Thank you.